Okay. And as we said last time, you guys reminded me that this is our last official meeting for Accounting 377. I am going to hold a supplemental question class next Tuesday. So that will be Tuesday by my look here, Tuesday, April 25th. Is that what we agreed to last time?
Yes.
Right. Okay, good. So we are going to do that, and the game plan therefore for tonight and next time for tonight would be to finish chapter 8. I don't see any problem with that. I'm pretty sure we'll be able to finish chapter 9, although that is stretching the expectations a bit. If we don't, then we will finish chapter 9 next time. And then we will go back to chapter 8. When I say finish chapter 8, finish the governmental discussion, chapter 8. Go back to the beginning of chapter 8, dealing with not-for-profit, because there's probably about 5 points to 10 points there that I want to make sure we get for you. And then we'll go back to chapter 10 to just pick up some of the key elements of chapter 10, which constitute a very small number of points in that total number of points of governmental, which is probably about 20 points. So when you look at governmental, it's between 20, 25 points, not-for-profit between 5 and 10 points. The big takeaway from that is that governmental and not-for-profit, even though we're sort of, chugging along here to try, turning and burning here towards the end to try to get it done, it constitutes a good chunk of the FAR exam. I see a lot of students on, these social media, Facebook, whatnot, saying, well, they didn't cover governmental, probably talking about Becker a little bit. And, I'm not here to defend Becker, but I do observe reality, which is if we've got, a whole chapter, chapter, almost 3 chapters, let's just put it that way, dedicated to governmental not-for-profit, that's telling you it is heavy. Okay, any question on that?
Before we start, Professor, I just want you to confirm what time will next week's class start?
Same time, Eric, 5 to 8. Unless folks have a preference, we're sort of on our own decisions here because it's supplemental. So if folks want to do it, I can do it earlier. I don't want to do it later, but I can get on like at 4 if that's easier or better for anyone. I don't know.
5 works well for me.
5, okay. Yeah, I think it's best we stick to 5 to 8. That way we don't have to think. We just come in on Tuesday, even though it's an extra class. Again, that is optional. I'm not holding anyone as a requirement to come to that class because I do realize, the term ends and people are moving to different projects and whatnot. And so, okay, question? Okay, well, there are no questions. Everybody hold your breath, say a prayer as I put my machine into tablet mode. At least the camera stayed on. Let's see if I can bring up the chapter 8 material, where by my recollection, we'd stopped at about page 57 here. Is that correct?
Yes.
Yeah. Okay, good. Okay, so what we're going to do, and I want to just sort of review the lay of the land a little bit. One second, guys. Not looking good. Let's try this again. Why do I have to go through that? Okay, never mind. Stop, John. Okay. So let's go ahead and bring it back to F8. Okay, and this will take me to the end of the thing for some reason. What page was it? 57?
Yes.
Okay. Okay, let's try this again. Take two. Always seem to have to go through that nonsense, but let's go ahead and let's take a look. Okay, and we talked last time about the three categories of funds. We had the governmental funds. I'm not going to write funds every time. They're all fund categories. Three categories. I'll write that. Three categories. Okay, we had the governmental funds. We had the enterprise funds. We had the proprietary funds, I should say. And we had fiduciary. Okay, and within our governmental fund category, we had four funds. We had, what were they? We had the general fund, we had the special revenue fund, we had the debt service fund, we had the capital project fund. Actually, we had four funds, and we had the what? Permanent fund. We had five of those. I said four, we had five. And we used that mnemonic GRASP to help us to remember those five funds that fall into the governmental fund category. What kind of accounting do we use in the governmental fund category?
A modified accrual.
Good, we use modified accrual. Modified accrual means that, for example, when we purchase a fixed asset, we debit expenditure. We don't debit capital equipment. Because we are trying to meet our accounting objectivity. Did we spend the money for the intended purpose, right? So we don't use full accrual accounting. When we get into our proprietary funds, we had two. Okay, we had the internal service fund and we had the enterprise funds. And these funds are fund types, right? There could be several enterprise funds. There could be several debt service funds for special revenue funds, I should say. These are all fund types. Okay, there are 11 fund types. There's usually only one general fund, only one debt service fund, but some of these others you could have multiple fund types, but the 11 fund types. And when we're dealing with our internal service fund and our enterprise fund, it's like a business. It's being run by the government. So what type of accounting do you think we use there?
Accrual.
Good, we use full accrual accounting. Excellent. And then we have fiduciary funds, and we had four of those. Okay, and for our fiduciary funds, we had the custodial fund, we had the investment trust fund, we had the pension fund, and then we had the employee and other employee benefits. And I was just telling you, just remember KIP. I don't know that it's necessary to say, the pension and other employee benefits. So those were our different categories of fiduciary funds. We had four of those. And if you're thinking that you're dealing with employees' pensions, you'd say, hey, I probably want what? Accrual accounting there. Okay. Now, what happens is we're spending most of our time tonight down here. F8, F9, we'll start to get into more of the detail of these different types of funds and what they do. But it's important to keep in mind that we also will have what? A set of government-wide financial statements. Okay, and when we look at those government-wide financial statements, we're really trying to get a higher level picture of how efficient is government at managing the resources that it owns in the delivery of services. And so what we do is we group that information into government activities or business activities. Government activities, business activities. And what we do is we take these individual fund statements and we essentially consolidate them into the government-wide statements. Okay, so this up here is a consolidation of the detail. Okay, this is a consolidation of the detail that we're seeing below in these individual funds. For this understanding governmental accounting for the CPA exam, we have to understand both levels because both levels are required to be presented. If you pick up the financial statements of any state or local government is what we're talking about here. This doesn't apply to the federal government. You talk about any state or local government, this is the fund structure and the consolidation of the government-wide that you will see. When we're at the government-wide level, we will be using full accrual accounting, just like we use for the fiduciary funds, just like we use for the proprietary funds, unlike what we use for the governmental funds, where we will be using modified accrual. We'll be digging more into that tonight. Any question on that? Okay, now, one of the things that we absolutely have to understand is budgetary accounting for these governmental funds. Okay, now this gets a little bit weird because all entities have a budget. Okay, all entities have a budget, and generally when we're talking about for-profit entities, anyway, if we're talking about personal financial statements and whatnot, there are no standardized budget requirements. Okay, so everybody can kind of do their budget however they see fit. In government, there absolutely are standardized budgetary presentations, budgetary journal entries. And so that being the case, we are going to have to understand something about the standardized governmental budgeting process. This is something that many people complain about, and the reason they have trouble with it, when they're talking about the CPA exam, and the reason they have trouble with it is because they don't spend probably the 20 minutes of study time that it takes to get this stuff down, and then they can just continue to struggle with it. Sometimes half the battle in life is just going ahead and spending the time doing the exercises you need to get the outcome, rather than dreading that exercise and wasting a bunch of time dreading it rather than doing it. Okay, so we're going to start that process tonight, and then we will reinforce that obviously through going through our homework questions and whatnot, preparing ourselves for our exam. Okay, so let's go ahead and take a look at the accounting for the governmental funds. If we're talking about the governmental funds, what funds are we talking about?
The 5 funds.
Good. General fund, special revenue fund, debt service fund, capital project fund, permanent fund. I'm having trouble with the mnemonic I've known for going on 30 years here. General fund, special revenue fund, debt service fund, capital project fund, permanent fund, GRSPP, pronounced GRASP. Okay, good. That's the accounting that we're going to be focusing on. So we will be understanding the budget, and when we get to the actual activity, what kind of accounting will we use for the day-to-day activity? That's what? That's modified accrual. Okay, so when you come over and you take a look at what they talk to us about here, we have this budgetary accounting. We have encumbrance, and encumbrance, guys, is also budgetary. Okay, so I put those in yellow here so that we understand that that's all part of what? Of our budgeting process. And activity is what? Activity, and we could call that, I'm doing a little legend down here, I guess. We could call that, if we want to, actual activity. Okay, this is the day-to-day actual activity. This is where we will be using modified accrual accounting. The budgeting process is in its own, is self-contained in its own right. I don't think there's any way I can get away from that line. I feel like I'm Sitting here, in some kind of weird spirit going back and forth between one dimension and the next, so. I don't know how annoying that is, but I think we just gotta roll with it. I don't believe there's a way for me to eliminate that stupid line. Okay, there you go. Sorry. Good. There is a way to do it because I just do it. Okay, good. All right. Now, when you come over and you take a look at the budgetary aspects, okay, let's just look at the budgetary now. And when we look at budgetary, let's just go over to the next page. And we say that the budgetary journal entries that we are going to have to know, and they are made only twice during the year. They are done at the beginning of the year and at the end of the year. Beginning of year, end of year. Okay, and so let's look at the beginning of year entry, and then we will come down in a minute and look at the end of year entry, but they're made only twice during the year. Okay, so let's first look at that beginning of the year entry, and we're going to flashcard this. Okay, and at the very beginning of the year, the governmental entity, state or local government, will need to sit down and decide how much revenue do we think we're going to generate during the year. It is an estimate. They've tried to figure out how much revenue. And when they figure that out, they go ahead and they debit this account called estimated revenue. Now that seems a little odd and backwards, probably, if you haven't looked at this at all before, because you're like, well, why am I debiting revenue? I've learned a long time ago, longer for me than you, right? That, hey, we are supposed to credit revenue when we think we're going to have revenue. Well, here's what's going on, okay? And you don't have to put this down here, but I'm just going to show you why we're debiting revenue. And let's say I have a revenue ledger. Okay, and in this revenue ledger, I'm going to have a column for estimated revenue, which we know will be a debit. I'm going to have a column in my revenue ledger for actual, and sometimes they just call it revenue, okay? But I just want to make sure that you understand that's actual revenue. They probably just call it revenue, okay? And there'll be a credit for that. And then they'll have a column over here for whatever the balance is. Okay, so when we debited that estimated revenue, as you saw up there, we would go ahead and we would enter that revenue here into this revenues ledger. And when we do, we'll have a balance of what? Not a trick question, $2 million debit, right? That's the balance, okay? Then what? Then we'll have actual revenue. I don't know, let's say that we issue some fishing licenses or something. I don't know, however this government is raising money. And so we'll go ahead and we'll debit cash, say 200,000 worth of licenses. We'll credit revenue, 200,000. We're not messing you up that much. When you start to have actual activities, just like you've known for a long time, you credit revenue to increase revenue. And when you go ahead and you credit that actual revenue, what's the balance in this thing now? That's a question.
0.
Huh?
0.
Not where I come from.
Was that 200 or 2 million?
Okay, this is 200,000. 2, 1, 2, 3, 4, 5 zeros. This is 2 million. 2, 1, 2, 3,
Oh.
4. So yeah, 2 million.
100 then.
Huh?
1,800,000, the balance?
Good, thank you. Yeah. So it's, thank you. Yes, it's 1,800,000. And so this government is saying, okay, we're moving along through the year here. We've gotten some of the revenue we thought we were going to get. We seem on track with our budget, right? Okay, good. Then what? Then a little bit later, I'm going to go ahead and debit cash again. And guys, I'm just making these numbers up, obviously. I debit cash 500,000, I credit revenue 500,000. Remember, those budgetary entries are only made at the beginning and the end of the year, right? So we're still in the middle of the year here, let's say. And so when I debit my cash, credit my revenue there, and I enter this credit into my revenues ledger, what's the balance now? Not a trick question.
1,300,000.
Good. Now it's 1,300,000. Good. And that estimated revenue amount sits there during the year as a placeholder against my actual revenue, so I can see at any point in time how I'm tracking against my budget. Okay. And the CPA examiners, the CPA wants to say, hey, do you know what the budgetary entry is that's made at the beginning of the year? Okay. Now, for appropriations, okay, they are kind of like estimated expenditures, but don't dare call it that. That would be the wrong answer on the exam. The official title for our estimated expenditures are called appropriations. Okay. A government is not allowed to spend money unless there is a legally adopted budget to do so. And they call that legally adopted budget an appropriation law. For example, federal government accounting is not tested on the exam, but since I've worked for the federal government for years, I know that the government finances its spending through the entire year through 13 appropriation bills. In fact, sometimes Congress plays little games and, the politics or such that they say, well, we're not going to pass the appropriation because one side calls the others names, and then they decide not to pass the budget, and they shut the government down, and everybody freaks out because they, shut down the parks or something. And it's a little political game that they play. And after a couple of weeks, they come to a resolution, they pass the appropriation bills, and then they can begin to spend again. Okay. The other game that they're getting ready to play on you, this is way outside of the CPA exam, but I feel compelled to give you a fair warning. They're going to start playing a game with the debt ceiling now. And what they're going to sit here and say to you is we have a debt ceiling and we shouldn't spend over the debt ceiling. Meanwhile, they've already passed appropriations that precluded the necessity to go over the debt ceiling. So they pass a budget that's going to take them over the debt ceiling. And then when they get ready to go over the debt ceiling, then they turn around and play a political game saying, well, we don't want to go over the debt ceiling. Then why'd you pass a budget that required you to go over the debt ceiling? The problem that the federal government has is each week, what they do is they have debt that is maturing. They issue more debt to pay off the debt that is maturing, and then a little bit more. And so that's how you end up over the course of the last 30 years from Reagan, 40 years, whatever, from Reagan to Biden. They always go ahead and, have a deficit, except for maybe a couple years. Clinton, of the 8 years that Clinton was in, 6 of them or 7 of them were deficit years. I think he had a surplus for 1 or 2 years. Most of the time they have a deficit. And if you do that for 4 years, one day you wake up and you have 30-something trillion in debt. Okay. And so if the federal government were to ever default on that debt, that would be the collapse of the world that okay? Because at that point in time, all of the countries that put their money into treasury securities because it's a safe place to put your money and whatnot, because they know they can trust the full faith and credit of the federal government, that whole thing will collapse. And that's when war will make the more sense than moving along as a, civilized society. So eventually they raise the debt ceiling. We're the only developed country in the world that does this, except I think Denmark. And Denmark has now raised their debt ceiling so high that they'll never go over it. So we're the only ones that play chicken with this nonsense. every so many years when it looks like they're going to go over the debt ceiling. So stay tuned for that. That should be interesting, seeing that we have a new way of looking at the way government's supposed to run these days. Okay, end of that. So whatever, you can't spend any money until you pass that appropriation bill. Okay, so when we finally pass that appropriation bill, we credit the appropriation account. They call it appropriation control, and they call it estimated revenue control because it is simply a control level, a GL level account. Underneath this, there will be various subsidiary accounts. Some will deal with public safety, some will deal with culture, and some will deal with education. And so we're just showing you the control level account because you don't have to worry about the CPA exam doesn't get into having you credit 97 subsidiary accounts. They just want to know, do you know how to deal with the GL level account appropriation? Now, I'm not going to write an appropriations ledger in here because we'll get to it later, but think about it. We credit our estimated spending, but we don't call it that. We call it appropriation. Our real spending will be debit, and we'll keep track against how we're doing with our budget as we go through the year. Okay. Now, when you look at this government, okay, planned to have, oh, come on with this nonsense. Oh. I'm going to video myself smashing it into pieces when I finally get rid of it. Okay, in this particular case, this government had a surplus. They had some what? They had some money that was left over. Okay, and many governments have a requirement that they either balance the budget or there be a surplus. It has to be one or the other. It can't be both. If you plan, and it's a plan, guys, when they have a deficit, it's not, oops, look what happened. They plan it accordingly, that they're going to have deficit spending, and that's what the federal government does every year. It's got to be one or the other. If you plan to spend more than you plan to take in, then you have a deficit. And again, if you have deficits year over year over year over year over year over year, then eventually you have a huge debt in the tune of whatever it was, 30, somebody looked up the number after I said 32 trillion. I forget what it is. Okay, but whatever it is, if I guess high, I'll be right pretty soon. Okay, now that entry is made at the beginning of the year. I want you to flashcard that. It sits there as a placeholder as we have our actual activity during the year. And then, of course, we do what? We close all our revenue. Oh, right here. Here's the end of year entry. Okay. We close all of our revenue and expense accounts at the end of the year. So it makes sense that we would also do what? Close all our budgetary accounts at the end of the year. And it is simply what? Since those accounts sat there all year as a placeholder, it is simply a reversal of what we had set up at the beginning of the year. Easy points on the CPA exam to know that at the beginning of the year, you debit the estimated revenue, you credit the appropriations, you debit an account called budgetary control for the difference. If you have a surplus, in other words, you have more estimated revenue than you have appropriations, you're going to keep a little extra money. That's going to be a credit to budgetary control. If you're going to spend more, you have a deficit, so you'd have to have a debit to budgetary control in order for that to balance. Question?
I have a quick question. I hope it's worthwhile.
Yeah.
I'm just watching the news, just based on your explanation. When, for California, for example, they said that we are in a deficit situation right now, as opposed to a surplus from last year. So Gavin Newsom, so he can't act like he's surprised that we had this wonderful surplus last year, but now we have a deficit. So am I understanding you right, that he knew it had a deficit for this calendar year?
Well, the state passes its new budget July 1st. So I would, they start their fiscal year, I should say, July 1st. So I would imagine that they're probably in the process of finalizing that budget, which would have to be in place to begin spending July 1st. So he's probably, and I didn't hear exactly what he said, but he's probably saying, wow, times have changed over the last 12 months, and we're not going to be able to have a surplus like we did. We're going to have a deficit spending, and it could be for a variety of reasons. All of a sudden we have to have deficit spending because there's been a downturn in the employment and we're having to offer unemployment benefits, or there's been, what was happening in 2008 timeframe, 2009 during the, Great Recession, I guess they called it. Because property values were plummeting the way they were, the state wasn't collecting as much property tax, and so they were in deficit situation there. So he's not looking at and again, I didn't hear what he said exactly, but he's not looking and saying, oops, we spent too much, we have a deficit. I think he's looking at the upcoming budget and saying, well, we're in a different circumstance and it looks like we're going to have a deficit.
Right, because I know I hear all the time that, oh, so many Silicon Valley billionaires or millionaires didn't pay as much in tax revenue for capital gains tax. So that reduces the amount of, I guess, appropriations that they're predicting. So, okay, I'm just trying to wrap my head around it.
If they don't pay if you don't collect tax revenue, that's going to make a potential deficit more likely because you can see the revenue's got to come in.
Right.
And for whatever variety of reasons, they don't collect that revenue. I gave the example of property taxes. You gave the example of something dealing with, capital gains tax, whatever. And I'm not a tax guy. Okay, an income tax issue, then you're going to have deficits, right? Unless you want to cut back on the spending. Now, I'm always under the, question when I hear, these discussions, why folks are rooting for, billionaires to not have to pay tax so that we can cut the programs and services that are necessary for, individuals that maybe need a little more help. But that's just, starts to become, and we can have disagreement on issues. We can't disagree on facts. So the fact is that if you collect less taxes, if you don't want a deficit, you have to spend less. So what makes sense? That's where you start to get into, to me, realistic, honest discussion, and I'm going too long on this now. Where I have a problem is when, now it's okay to look in the camera and say, well, we don't have a deficit when we do. I mean, they literally do those kinds of things now, or they'll say, it's okay to default on the federal debt. And they'll look in the camera and they'll say that when that is not correct. And so those kinds of things are, to me, more scary things than disagreements that we've had for a long time as to, how do you spend the money? How do you collect the money that you need to achieve the objectives of the government? And what are those objectives? All of those things, to me, are fair debate. Facts are not debatable. And I think there was a court settlement today that hopefully is moving us in the right direction in that regard. And I'll stop there. Okay.
Thank you. Thank you.
Yeah. Okay. So we have the budget set up. Any question on that? Okay. Guys, you got to know this though. CPA exam, knowing the beginning of the year, end of the year entry, 5 to 6 multiple choice questions right there. Okay. They just want to catch the person that tunes out towards the end of the class, doesn't pay attention to the stuff that's at the back of the book, and then's going to come in and, give us the story. Well, Becker didn't cover that. Here it is. Okay. And we're covering it. Okay. All right, good. That's the main trick, is making sure that you cover it, you flashcard it, and you work the multiple choice questions with it. And it's not that hard. If you give me, and of course, I've got a little more, vested in government stuff, but if you gave me the choice between doing this stuff and doing a consolidation, I'll pick this 10 times out of 10. Okay, so I think these are relatively easy 20 to 30 points you're getting if you put in the requisite time. Okay, shut up. Okay, now I'm talking to myself. Now you come over and you look at actual activity. And again, I'm calling it actual activity just so we understand, okay, we set up our budget. Now we're going to go through the year and we're going to have actual activity. Okay. Now there's something called non-exchange revenue. And there are 4 categories of non-exchange revenue. There are derived non-exchange, imposed non-exchange. There are, going over to the next page, government mandated voluntary non-exchange and voluntary non-exchange. 4 categories of non-exchange revenue. Now, the reason they call it non-exchange, and let me go back up there. The reason they call it non-exchange, what happens? For example, a imposed non-exchange, classic example is property tax. Now, do you pay your property tax?
Yes, 2 weeks ago.
Go ahead. Try and not pay it, see what happens to you. Okay. So what happens? You pay your property taxes. You got to pay your property taxes, right? Now, what happens? You pay your property taxes, and then do you sit there with the government saying, hey, give me some service? No. You pay your property tax and you expect what? You call the police, you expect them to come. If you need this from the government, you expect to get it. Okay, you expect the roads to be maintained, all of those things. So there's no exchange. It's not like you pay it and then you say, hey, or let's say you need the police, right? It's not like the police come up to you and say, help, somebody stole my purse. You don't expect the police to come up and say, well, do you want us to chase the person? Because if you do, that's going to cost you $100. And do you want to chase them on foot or in the car? Because the car is a little extra. And for a little more, we'll make them pay the ultimate price, right? No, that's not how it works. You pay your taxes, and then you expect the government to do what they're legally required to do. That's why they call it non-exchange. Okay, now we'll learn later that there are exchange revenues that the government collects. For example, when you pay a city-run bus, the fee to ride on the bus, you expect them to give you the ride on the bus, right? That's an exchange revenue. And so we'll get into that later. But right now, we're talking about the governmental funds and their categories of revenue, which we're calling here non-exchange revenue. Now, when you look at non-exchange revenue, okay, and I just want to first go over to e-learning. And I want to point that under chapter 8, I've got some of these slides here that I want you to look at as we're going to go through the evening here. And one of them is this one, non-exchange revenue. Okay. And so I'm going to go ahead and see if, when I had to go through the little maneuver with my computer. Looks like maybe it's still open. Let's see. Yeah, okay. At least that went well. Okay. Now, when we look at non-exchange revenue, okay, when we look at non-exchange revenue, I think it's worth, even though this is titled deferred inflow, I think it's worth looking at this right now. And we're going to get more into this later, okay? But when an entity, when a government receives money, they have to evaluate that money to see where on this continuum it belongs, okay? So if they receive revenue and they have not met eligibility nor time requirements, it is a liability. It is like an unearned revenue, okay? It's often called revenue collected in advance because they're not eligible for that revenue and they haven't met any time requirements with it. So what happens? The higher level of government says, hey, you can have this money, but you have to be eligible for this money. And if they receive that and they haven't been eligible for it yet, then it becomes a liability, okay? Then what starts to happen if the government becomes eligible, they meet certain requirements, sometimes there'll be a time requirement on that money. They'll say, well, you can only use it during a certain time. And so if you met eligibility but not time, then it becomes a deferred inflow. And I give you the caterpillar versus the cocoon here. Starts out as a caterpillar. If you don't meet eligibility or time, you meet eligibility but not time. Now it's in the cocoon waiting to become the revenue butterfly. And when you meet both eligibility and time, now you can be recognized as revenue. And as you can see on the previous slide, once you're in that revenue category, then you have to see, well, what category of revenue am I? And we're talking about non-exchange here, okay? So you could be a derived non-exchange, imposed non-exchange, government mandated non-exchange, or a voluntary non-exchange. All of these are considered non-exchange, you can see from the heading, okay? Now, if we are talking about derived non-exchange, they give you certain examples here. I give you, I guess, certain examples here, which include things like our sales taxes, our income taxes. They call it derived, okay, because it gets its underlying value from some underlying transaction. So if we're talking about income tax, what's the underlying transaction that generates income tax?
Taxable wages.
Yeah, the earning of the income, right? Okay, how about sales tax? The sale
Purchase
is
price.
the transaction. Good. Okay, now what happens? We look at eligibility and time, but eligibility only applies to the government mandate and the voluntary non-exchange, and I'll talk about that more later. So for the derived and the non-exchange and that continuum up from, and I guess it would never be a unearned revenue collected in advance. So if the government gets some money and it hasn't met time requirements, it's going to be a deferred inflow until the government meets the time requirements, and then it will become revenue, okay? And they tell us that the revenue is recognized when the underlying transaction takes place. Now, this is necessary for accrual accounting, which is not used by our governmental funds, right? They use modified accrual accounting, but you can still use much of this, but now you have to layer on top of that, that for our governmental funds, when we're dealing with modified accrual accounting, we also have to apply, and again, I'm using the most common one, 60-day criteria. Remember, we said last time, in order for something to be recognized as revenue, it has to be available to finance expenditures of the current period, which GASB doesn't call out 60 days, but many governments use 60 days. Could be 30, could be 60, could be 90, could be 180. It doesn't go much beyond that. Read the question carefully to make sure you understand what criteria they're using. Often they'll just say, and I think we saw one like that, where they'll say, well, they intend to collect, they'll tell you about how much they can collect in 30 days, 60 days. And then they'll say the rest is going to be collected in the balance of the year, which is a funky way of telling you that their criteria is 60 days and only include amounts that will be collectible within 60 days. Okay, now that's our derived category. And so I want to go ahead and come out of this for a second. I'll come back to this as we go through the other categories, but I want to just stop right here and give you a little example of non-exchange and, understanding, derived non-exchange and understanding that the example here would be, sales taxes, okay, which we saw on the slide that I have over there, but also here it is again, okay, sales tax, income tax, okay. But let's go ahead and let's take a look, and let's say that this government has $1 million of sales, and the sales, we'll make it City of Hayward, okay. Sales taxes that it has earned of $1 million. So there were sales, I don't know, the sales were $10 million, whatever, but they're going to get tax on that of $1 million. Okay. And we'll just say that's in December 2023, whatever. Okay. Now, what happens? The sales take place in December 2023. They collect 800,000 of that in January. What's going on with the pen? Whatever. January 2024, and then 200,000 in April 2024. Okay. Now, if I ask you what's the revenue under accrual accounting, and by the way, guys, that would be what? That would be how you'd account for this on the government-wide statements, because government-wide, I told you earlier, use full accrual accounting. So that GW is government-wide. Let me just put that in since we were talking about government earlier in presidents. I don't want you to think I mean George W. Bush. Okay. Government-wide, what would be the amount of revenue? That's a question.
800.
Well,
million.
huh?
So it would be the full million?
It's the full million because the 800,000 is only what? Only relevant to modified accrual accounting. Okay, that's the way that chart works, and that's why I'm giving you this example. That little chart I put up there a minute ago. Okay. This thing told us that what? Told us that the modified accrual was where the 60 days and modified accrual criteria comes in. And modified accrual is used by who? By the governmental funds, not by the government-wide statements, which use what? Use accrual accounting. Okay. So if that's the case, then we'll go back to sorry guys, my thing is playing hide and seek with me. Okay, but if we're sitting here, what am I looking for? Okay, if we're sitting here and we're looking at this example now, then what? Then if I ask you this same question, and now we're talking about what? Now we're talking about the general fund. Let's say general fund uses what kind of accounting?
The modified.
Modified accrual. Well, now we got to think about that 60 days. So if I ask you what's the revenue, if the exam asks you what's the revenue at the, for say the general fund, and they may not call out under modified accrual, they may say for the general fund, what would the answer be? Paulina.
would it still be the 1 million because we're taking into account the 90-day into 2024?
Well, I'm using 60 days here.
Oh, 50 days?
Yeah,
Okay. Then it would be the 1 million?
well, okay, in order to be revenue under modified accrual accounting, it has to be collectible within 60 days of
Okay.
the year end, and I probably should have told you, the year end is 12/31. Okay, so if the year end is 12/31 and they're not gonna collect 200,000 until April, how much is the revenue?
800.
800,000, because that 200,000 is what? Not gonna meet the time requirement of the 60 days, right? Guys,
Correct.
hello, everybody?
Yes.
Yeah.
Okay, now that's the 2023, I mean, yeah, 2023 revenue here, okay, that amount's not gonna come until not gonna come until April 2024. That'll be 2024 revenue under modified accrual accounting. So there's a difference between full accrual and modified accrual. Now, let's just take a look at the journal entry here, okay? For the full accrual, and I'm going to ignore uncollectible taxes here. For the full accrual, they would debit sales taxes receivable, $1 million. Easy enough. They would credit revenue for $1 million. For the general fund, the same transaction, since we're going to have repair statements at both the government-wide and the fund level, the journal entry would be debit taxes receivable for $1 million. That's the same. We can only credit revenue for what? For
800.
1,000. And since we haven't met the time requirement yet, we would do what? Credit deferred inflow for 200,000. And as we said last time, that deferred inflow sits there right next to the liabilities, although it's not a liability because what? We don't have to worry about eligibility. The government is eligible to collect sales taxes. You try to walk out of a store with some, merchandise and not pay the sales tax. They have they have a name for that. It's called shoplifting. Okay, so you're going to have to pay the sales tax if you want to take it out of the store legally. And so they don't have to worry about whether they're eligible for the sales tax, but they do have to watch that time issue. Question. Okay, good. Now you come over and we have the imposed non-exchange. Okay. And with the imposed non-exchange, just going back to my little slide here. Okay. And this is if I may take credit for my own slide, okay, I think it's pretty useful because it gives you the type, tells you that they're non-exchange, gives you the type, gives you examples of what we mean, if it meets time or eligibility requirements, and then it gives you the rule for when the underlying transaction took place for our derived. For our imposed, and they give you example like property taxes, fines, and penalties. What happens? The government tells you, this is the value of your house, pay 1% of that. There's no negotiation. There's no back and forth. You pay your property taxes, assuming you want to keep your house. If you get what? If you get a ticket, once they have legally enforced that ticket on you, you don't have any choice. You're going to have to pay it if you're adjudicated guilty for whatever that ticket is. Now, again, the government doesn't have to ask itself if it's entitled to property taxes. Okay. And they tell us that you can recognize that when use may first begin. So what happens? Sometimes what happens is the government will mail out its tax bills towards the end of, say, the calendar year in December, and they'll tell you that money is due in April. Now, some taxpayers will go ahead and they'll pay their property taxes before they're due. They'll pay them in December, even though they're not due until April. Why would a maniac do that?
So to increase a better position on your federal income tax returns.
They want to be able to deduct that tax on their federal income tax return, although
For California, it doesn't work
But
anymore.
in Tax Act at the federal level that was passed by the previous administration, limited that to $10,000. So California is screwed. So it probably doesn't matter when you pay it, because I'll bet you're paying more than 10,000 property taxes. Anyway, assuming you hadn't already gone over the rainbow in terms of how much state and local taxes you had paid, then you might hold back to pay that, or I mean, excuse me, you might go ahead and pay that now, so you can take it a deduction in your 2020, say 3 tax return, even though that wasn't due until 2024. Well, the government has a little dilemma because they have all this money pouring in, but they don't want to get into the situation where they start to pour through it, spend through it, and yet they needed it for 2024 because it wasn't due until 2024. So sometimes the law will say the government cannot spend that money until it was legally due, the year for which it was legally due, which would be 2024. If that's the case, the government has not met the time requirement. And so they would have to sit there and do what? Debit tax, well, in that case, debit cash, credit what? Credit deferred inflow, because they haven't met the time requirement yet. And then as soon as they get into 2024, they can debit deferred inflow, credit the revenue, but that would be 2024 revenue. Further, if it so happens that for whatever reasons, those property taxes are not going to be paid until what? Until say April now of 2025, you'd have to apply what? You'd have to apply the 60-day criteria under modified accrual accounting in that scenario. Question. Okay. All right. So those are the 2 most common categories of government, I should say, of governmental revenue contemplated on the CPA exam. And by the way, guys, this is about as theoretical as anything gets when it comes to the governmental. And you're probably getting more coverage here than is necessary, but I find it helpful, I believe, to my students to go to this level, because what happens is the study material doesn't quite go to that level, but then kind of like starts expecting you to understand that level. And that's when you start to get confused. And I don't want you to lose confidence in your understanding of this material. And that's the reason I'm going a little further with it. Okay. Now, in this example, okay, we're dealing with property taxes, which is a derived non-exchange. Okay. We're going to show you some journal entries here. And I think it's worthwhile flashcarding these journal entries for the scenario that they're giving us. Okay. And so in this particular case, and by the way, guys, we're assuming that we're making these entries for a general fund. This is not government-wide entry, okay? But it wouldn't really change if it was government-wide as to what we're doing here, because they're assuming that everything is going to be collected within the 60 days or soon enough after the year end to be available to finance expenditures of the current period. Whether that's 30, 60, 90, really depends on what the question tells you. I'm just going to kind of start to morph into just discussing that 60 days quite a bit, because most of the time that is the case. Okay, but what happens? We go ahead and we debit tax receivable current. We mail out the tax bills. We credit revenue, okay, but we reduce the revenue by the amount we think we're not going to collect. Okay. Now, this is different than what you do in commercial. As we learned in commercial, you would do what? You would go ahead and debit the, if it was sales, right? You debit the accounts receivable gross. Okay. And you would credit what? You would credit the sales gross. And then at the same time, you at some point would be required to set up a bad debt expense and credit allowance, right? And the allowance would be a contra to the accounts receivable. Remember that? Okay, we discussed that back in whatever it was, F4, whatever. So it's a little different than what you're going to do under, an exchange revenue situation. When it's non-exchange like this, you have to go ahead and you have to you have to reduce the revenue by the amount you think you're not going to collect, and you set up an allowance. And since the taxes were current when you first mailed out the bill, the allowance for uncollectible taxes is also current. Okay. Now, what happens? You have this 1.8 million set up in the taxes receivable. And now you have the situation where you have collected 1,458,000. Isn't that beautiful? Isn't it nice to be a government? You send out tax bills, you don't do anything, and people send you money. Beautiful. Okay, so they send us 1,458,000, and we still have 342,000 to go. Now, some people don't pay their taxes on time. We call those people delinquent. Okay, and if they are delinquent, we will go ahead and credit the property taxes receivable current for 342. Okay, now if you were thinking about the taxes receivable had been set up for 1,800,000, and then we credited it for 1,458,000, leaving it a balance of that 342. And now we're simply doing what? Taking it out of the current, okay, and putting it into tax receivable delinquent. So it is a simple reclass. It is taking it out of current and into delinquent. Note, guys, that taxes receivable is a current asset. Remember, for our governmental funds, we only have what? We only have current accounts, okay? So current means that they're not late. Delinquent means that they're late, but taxes receivable is still considered a current asset for these purposes. Okay, now what happens? Since we had gone ahead and reclassed the allowance, and we had allowance current, right? Allowance current up there. We had credited that for 180,000. Okay, now we're going to debit allowance current for 180,000, and we're going to credit allowance delinquent for 180,000. And we're going to take what? That remaining 162 that we hadn't collected yet, right? You have that 342. You took 180 and you put it in the allowance now from allowance. You never did think you were going to collect it, and you put it from allowance current to allowance delinquent. That 162 that was sitting in revenue, right? Because we hadn't originally anticipated that we wouldn't collect it. That amount's going to do what? We're going to put that into revenue, and we'll credit the allowance delinquent now 162. Thus, we get that total 342. I broke them out into two so that you can kind of see what happened there. Question. So by the end of it, you reduce the revenue by the amount you are going to put into the allowance. It's just that we didn't realize that we had an extra 162 that we were gonna have to put in the allowance until these people started getting late. We said, uh-oh, we better put the whole amount into the allowance. And so we had to back it out of revenue. Question. Okay. Now you come over, and that would be how you would handle the situation with the property taxes again, assuming that we were thinking that we were going to collect everything within the 60 days, and then when we started thinking we weren't even going to collect it, period, we took it out of revenue, right? Okay. Now for the government mandated non-exchange, this is when a higher level of government tells a lower level of government you have to do something. For example, okay, let me go back. I think I'll just go back to my little slide over here, okay? For the government mandated, for example, the higher level of government tells the lower level of government, you need to maintain certain environmental requirements for water. Now, why does the state have the right to tell a county that they have requirements for water? Well, because water flows across county lines and we need some controlling entity to tell us what to do. So they say, hey, you've got to do these testings to make sure the water is clean or whatever it is they do, okay? And so what happens? The higher level of government will probably give some money towards that mandate, okay? They'll say, here's some money. And often what the state will do is the state will say, you have to spend that money during the state's fiscal year. Now, if I'm a county, okay, and I am on a calendar year, but the state's year starts, say, July 1st, which many years do, they give me this money July 1st, but I'm going to use what? I got to use that money to cover me for the current year through December. And then I'm gonna have to use some of that money to cover me from January until June of the next year. So is this, you know, say that was 2023, 2024, is that 23 money or is that 24 money? The standards tell us that is 23 money because the what? When eligibility may and use may begin. Now, even though they're calling out eligibility there, guys, it's somewhat of a misnomer for the government mandated, because what happens? What's the county going to do? Tell the state, here, I'm not doing this. The state's going to say, yes, you are, and we'll see you in court. And then they will be compelled to do it. So eligibility really is not a big deal. It's more time. And for the time, the county in that example, when use may begin, they can begin using that money, what? In this example, July 1st, because it says it has to be used in the state's fiscal year, and they would take all of that revenue, even though what? Even though much of that money will be spent in the next year. Now, since these government mandated fundings don't vary much year to year, it really doesn't make a material difference anyway, because they're going to get $1 million this year, $1 million next year. The fact that they're spending some of it in this year and recognizing all the revenue, you know, spending some of it next year, I guess I should say, and they're recognizing all the revenue in this year, over time, it really doesn't have a matching problem because they're getting pretty much the same amount year to year, and that just little discrepancy flows forward. Question. Okay, so far, when you look at this eligibility, even though technically they're saying eligibility applies to the government mandated, it really has no real bearing until you get to voluntary non-exchange. With voluntary non-exchange, I apply for money from that higher level. I say, please, I want to build a community center. And please, and often the federal government helps with this kind of stuff. Please, federal government, I'm going to develop a community center. Please, Department of Housing and Urban Development, let my project be the one that you decide to give money to. And what HUD does is they have so much funding, and they go through and they evaluate project by project, proposal by proposal, who they think they want to give that money to. And when they run out of money, they stop giving. So we're sitting there and we're saying, please, if I'm the county, I'm saying, please, I hope I'm one of the bids that win. It's a competitive bid. And so I'm not eligible for that money until what? Until in that example, HUD says, congratulations, you've got this money that's coming. At that point in time, I can do what? Debit grants receivable and credit the revenue, and they usually give us the money a little later. So when you're talking about these government mandated and voluntary non-exchange, that transition through unearned to revenue is to deferred to revenue. It's usually what? Hey, I've been granted the money, now I can recognize the revenue. Or if I'm sitting there and sometimes they'll say, you have to spend the money to be eligible for the money, then what? Then I go from a liability and I don't make any stop at deferred inflow, and I go completely to revenue at that point in time. And so when we go back to the textbook, trying to hold all this in our brains here, okay, notice that they tell us that time requirements are applicable to all categories of non-exchange. Okay, we saw that from the little chart. Okay, whereas what eligibility requirements are only applicable to government mandated and voluntary. Okay, and let's take a look at what starts to happen for the contingencies. Okay, we have to meet certain usage restrictions, etc. In other words, we have to be approved for that particular project. Okay, and that only comes up with the voluntary non-exchange, as I mentioned. The voluntary, you've applied, and so they're going to say, well, you know, we've approved your request for this money because you're going to use it the way we want you to. Reimbursements, okay, can come up in both the government mandated and voluntary non-exchange. And so what they could do for a reimbursement, they'll say, they kind of, I always like to pretend, I like the movie The Godfather, so they're like our Godfather, and they say, go ahead and spend the money and we'll reimburse you for whatever your expenses are, so long as your interests don't conflict with ours, right? Of course, in the mafia movies, their interests always conflict, and that's when the movie really gets interesting, right? But here, you know, we're going to assume that their interests won't conflict. So what'll happen when they spend the money, they'll debit expenditure or whatever, it doesn't matter the amount, they'll credit cash. Now they've met what? They've met the requirement, which is, hey, you have to spend the money to be eligible for the money. And so at that point in time, they would do what? They would debit grant receivable, whatever. And they take the revenue at that time because, you know, they don't have to worry about time because it was a reimbursement. They spent the money, they get the money. So they go straight from nothing, right, to what? Now, sometimes they could give them the money, and then once we get the money, we'll debit cash. We'll debit cash. And we'll credit revenue at that point because now, you know, we've met the requirement and I can take that revenue. And I'm not revenue, but grant receivable. Sorry, guys, grant receivable, GR. We'll credit that. Now, sometimes they may give me the money in advance. And if they do, and they say, hey, you know, it's yours as long as you spend the money the way we told you to, then when we get the money, of course, we would debit cash. We can't credit revenue yet. Okay, this is also reimbursement, so to speak. We can't credit revenue yet because we haven't spent the money. So we would do what? We would credit revenue collected in advance. Okay, and then when we spend the money, we would debit expenditure, credit the cash, and then we can go ahead and debit the revenue collected in advance, and we can finally recognize the revenue there. So in that case, it jumped from the liability all the way up to revenue. This is a liability. Okay. All right. Now, with all that, let's go back one more time to these slides here that I had for you. And then I guess we'll take a break, I guess. And let's look at this problem. Okay, and I know this is hard to see on the screen, guys. So, you know, you might have to increase the screen size or get a little closer or something. Okay, but let's look at this because this is a good example where we finally bring in all three: eligibility, time, and eligibility and time in case we go through this. So, and so we'll have revenue, we'll have the unearned revenue, we'll have the deferred inflow. So Progressive Township Community College received 900,000 multi-year research grant. Okay, I don't know if she's going to give a community college a research grant, but maybe you would. Available for use on a prorated basis for the next 3 years, subject to other enrollment-based eligibility requirements. At the end of year 1 of the grant, the college had achieved enrollment levels that satisfied grant eligibility equal to 500,000. As a result of the transaction, how should we segregate the money here into whether it is revenue, deferred inflow, or unearned revenue? Now, you go ahead and we got what? We got 900,000. We have met the what? The time requirement now for 300,000 of that. And since we've met eligibility for what? More than 300,000, 500,000, we can take that whole 300,000 as revenue. Now, what happened? We've met eligibility for 5, but we've only met eligibility and time because we have to spend it over 3 years for 300,000. So 200,000, we've met time, but not, we've met eligibility, but not time. That's a deferred inflow. And then for the remainder of that, since we haven't met neither an eligibility nor time, then that is what? That's the 400,000, which you also could have calculated by saying 9 minus 5 is the 400, where we haven't met the eligibility. That's an unearned revenue. Okay, so that's a nice example of one, even though probably not very realistic as to how things actually work in the government. I don't think that necessarily every single category of revenue jumps through all of those hoops. Here's one where we're dealing with what looks like it's probably a voluntary non-exchange that did jump through all 3 hoops. Okay, question. That's from your homework, by the way. You'll see that in your homework. Question? Okay, this to me, guys, is about as theoretical as anything gets. I think this is a good flashcard to have, though, to help you remember what this discussion was all about. And with all that, what do I want to do here? I think we can stop there and take the break. Okay. So we'll come back. I'm showing 6:25, so we'll come back at 6:35. 6:35. Okay, I'm gonna go ahead and jump us back in. I forgot to hit pause on that, so I guess we'll have to fast forward through that if you decide to come back and watch this later. Okay, so we've kind of dealt with revenue. Now let's deal with the other side, of course, which is the spending. And we take a look, and we mentioned this last time, but when we deal with expenditures, both capital expenditures and operating expenditures are both considered expenditure. So police cars and police salaries are both going to be expenditures. We do not account for long-term items such as fixed assets. And again, remember now, even though I kind of floated a little bit into the government-wide discussion, we are really here primarily, for the most part, talking about the governmental funds, okay? The general fund, special revenue fund, debt service fund, capital project fund, permanent fund, okay? Now, that's the long-term assets are treated as expenditure, but we have some things like prepaid items, inventory, which are current assets, okay? Supplies, prepaids, right? Inventory are current assets. But GASB gives the option of either using the purchase method for that, or we could use the consumption method. And they pretty much tell us, well, we'd rather you use the consumption method because that's closer to how you should account for current assets and whatnot, but will allow you, if you choose, to use the purchase method. Okay, so we're going to want to understand both of these methods, but let's go ahead first and make sure I remember to tell you to make some flashcards that you can account for the purchase of certain current assets, supplies, prepaids, inventory, using one of two methods, either the purchase method or the consumption method, okay? Under the purchase method, you will record an item like this, like say inventory or supplies inventory, whatever, treat it as expenditure at the time that you purchase under the purchase method. And then at the end of the year, you will have to make an adjustment to record a current asset and something called a non-spendable fund balance. And we'll get more into the categories of fund balance a little bit later. But a non-spendable fund balance is one of the categories that we're going to learn about, okay? And you'll treat it, you'll set that up at the end of the year. You'll have to make an adjustment for any amounts that are still on hand. Under the consumption method, you will go ahead and record the purchase and flashcard that about the purchase method. Under the consumption method, you will go ahead and record as a current asset when you purchase, say, supplies, inventory, whatever. And then as you use it, you will go ahead and report expenditure. Okay. Now, they give us these journal entries down here, and they make this little cop-out statement down here at the bottom, and they don't really end up explaining enough here, in my personal opinion. Okay. So what I did was I went ahead and I came up with my own little example here that is on e-learning there. I showed it to you earlier. It's an Excel file, and I'm going to see if it's still open. I think it is. Okay. So I'm going to go ahead, and it's very similar journal entries that they've shown you there, but I want to kind of give you more of a comprehensive, thorough discussion of this. Okay, so I'm looking, and you can see this highlighted piece over here on the side. Let's see if my pens are going to work for me. Okay, good. You can see this over here. That's already highlighted right here. Okay, I'm highlighting it again right here. Okay, and I say that before you purchase any supplies inventory, we have cash of $100,000, excuse me, and unassigned fund balance. Again, this example would be better if the book had given us the categories of fund balance discussion first, but let's just roll with this and we'll understand more about the categories of fund balance later, okay? But just understand now that we have cash, we have unassigned fund balance, no liabilities. Remember, cash, assets for our governmental funds current assets equal what? Liabilities plus fund balance. And fund balance is like retained earnings. Remember, we said that last time. Okay. Now what happens? I go ahead and under the purchase method, right? We have purchase method, consumption method. I debit expenditure, I credit cash when I purchase 100,000 for inventory. Okay, that's what the book told me. I got a debit expenditure under the purchase method. I credit cash. Okay, now what? I'm sitting there and my balance sheet is a little out of balance. Okay, just immediately after purchase because I don't have any cash, but I haven't touched that unassigned fund balance. But we're going to deal with that when we go to the closing entries. Okay, so continuing on though, I go ahead and I spend 45,000. I use 45,000 of the inventory during the year. Under the purchase method, no entry because I already treated it as an expenditure. But as the book told us, and I had you flashcard, if you look at the statement of revenues, expenditures, and change in fund balance, which is the income statement for my, I'm assuming it's a governmental fund, say the general fund. I have revenues of 0, I'm assuming, expenditure of 100,000. So my change in fund balance is this negative 100,000, right? Now, what happens? I come over and I have to make my closing entries. And what I do is I close my expenditures by crediting them, right? I debited it when I bought the inventory to turn it back to 0, which is what you do with closing entries for profit and for profit, right? I credit the expenditure 100,000. I debit the unassigned fund balance 100,000. Now, when I debit the unassigned fund balance 100,000, and if we were sort of, using a T account analysis of it, when we began this whole thing, it had a credit balance of 100,000. I just did what? I just debited the unassigned fund balance for 100,000. So I've zeroed that out. And then I have to set up that if I spent what? If I bought 100, but I've only used 45, then I have what? 55,000 left. And if I have 55,000 of inventory left, I debit inventory 55,000 and I credit non-spendable fund balance for 55,000. So when I look at my balance sheet at the end of the year, I'm showing what? Inventory 55,000. I'm showing you non-spendable fund balance of 55,000. Now, if you were to look at, and for this, you need to look at chapter 9, okay? And if you were to look at, say, the general funds balance sheet, and I guess I'll put this in full screen. Okay, what you'd see in the general funds balance sheet, if you were to look at the inventory is showing 55,000. We know how that inventory number got there because we just debited inventory for 55,000, didn't we? We created it when we debited inventory for 55,000. When you look at the fund balance, okay, and it doesn't track exactly because you got this, instead of the unassigned being 0, you have of your fund balance, you have a portion that's unassigned. There's a total of 1,627,027. 1,527,000 of that, all but 100,000 is unassigned, okay? But we know that we have non-spendable for inventories, and I'll explain these categories of fund balance to you in a minute, but we know that that would be there because we just credited in the example that I gave you unassigned fund balance 55,000. That's how those numbers got there if we were using the purchase method by that end of year adjustment that we had to make there as we close the expenditure and set up the fund balance and the inventory. And those two numbers always match. Inventory and non-spendable fund balance for inventory, those two numbers always match. They're always the same number. Question. Okay, now that one is what? That is the purchase method, but we said, hey, you could use the consumption method. Now, consumption method is much more like the perpetual inventory method. It's much more like full accrual accounting, okay? And that when I purchase the inventory, I debit inventory, I credit cash. No surprise there. That's how you do things, right? And so as soon as I'm done, the balance sheet looks pretty good, and that inventory is showing 100,000, and I haven't done anything yet. Well, actually, hang on, guys. Let me look at something. Yeah, okay. Do me a favor and ignore this. Yeah, I forgot that I had fixed this, so ignore that. Ignore that, okay? And let's just come over and let's look at how we'll do this when we make adjustments during the year. Okay, right here, okay? So what happens? I purchase the inventory, I debit inventory, I credit cash, right? Okay, I debit the inventory has 100,000, but under the consumption method, which is what we're looking at here, I'm going to set up my unassigned fund balance as I buy and use the inventory. So what I do here is I go ahead and I debit the unassigned fund balance and I credit the non-spendable fund balance. When I debit the unassigned fund balance, now it's zeroed out, and I credit what? I credit the non-spendable fund balance, so that now my inventory number and my non-spendable fund balance are matching. And as I go through the year, I'm going to adjust this. Then I do what? Then I debit expenditure, I credit inventory as I use that inventory. So the inventory account after I credit is showing me 55,000, which is what I have left. I'm showing that I spent what? I spent 45,000 of that. I'm showing that expenditure. And then I adjust my non-spendable fund balance, okay, by doing what? I debit the non-spendable for 45, and when I go ahead and debit that, it's now showing 55. The inventory account and the non-spendable fund balance account are matching, which is what they need to do. And I credit the unassigned fund balance, and when I do, the unassigned balance shows the 45,000. But then when I make my closing entry to close my expenditure of, now it was only 45,000, but I still have to close it. I credit the expenditure, I debit the unassigned fund balance now comes down to 0. And all that's left is what? The inventory 55 and the non-spendable fund balance at 55. Thus, if you go back to that first tab, the balance sheet by year end looks the same under both methods, but for the consumption method, the notion was that I wouldn't have to do anything at year end because I would have kept track of the journal entries as I went through, as I just showed you on that previous tab. Okay, so that balance sheet that I showed you over here, okay, that's going to look the same under either method. Okay, now just going back to finish up the discussion here that you saw in the book here, they say regardless of the method used, inventory asset amounts will be balanced with non-spendable fund balance. Okay, and we saw that, so why don't you go ahead and flashcard that. Okay, and they say it in year end, there's no entry. That's because we did what? We would have kept track of the things as we went along. And you can put in here CF9 page, and I believe it was page 19, where we looked and saw how all that looks, where the two amounts match on there. Okay. Question. Okay, good. Now, what happens? When we have expenditures, we have different categories of expenditures, which you should flashcard, okay? And we can organize, and it's really up to the government as to how they want to organize those expenditures. We can organize them, for example, by function or program, if that's what we want to do. Functions and programs you can put down here are things governments do. Okay. For example, public safety. Okay. The government is supposed to keep you safe. Okay. Now we know that they fail on that mission, and sometimes they're the ones that end up not making some of us safe. But as a general concept, they're supposed to keep us safe, right? Okay. Now, what happens? What we do to achieve functions and programs, you can flashcard all of these. We form organizational units. Okay. Example of organizational units are the fire and police department will form the what? Public safety function. There's a burning building. We rely on the fire department to come and save us from that, right? Public safety. Okay. Police, same kind of thing, I guess. Okay. Now, you come over and the organizational units then engage in activities. And for some strange reason, Becker stopped giving us examples, but I'm going to put down here as an example. And when I say flashcard, I think just flashcard the example, by the way, guys. You know, if you look at the flashcard, they have the organizational unit corresponds to the organizational structure of the current and organizational unit may be responsible for care. You're not going to remember any of that. Remember the examples. That helps you remember what these different categories are about. Okay, and then all of a sudden they stop giving us examples. And a good example here might be building inspection. Okay, so what happens? Under the public safety function, which is something the government's supposed to do, the organizational unit fire department inspects buildings to make sure that all the exits, and there's been cases where they've gone in and the fire exits are blocked or something stupid like that. So they're supposed to, you know, find those things and not have, you know, stupid accidents happening, you know, negligent accidents happening. I have a friend who was is now retired. He was a city San Jose police officer, and we'd be watching football on a Sunday, having a good time, having a couple of beers, and all of a sudden you'll, oh, and I'm like, what's the matter? Oh, I got to do patrols tomorrow. And I'm like, what's patrols? And patrols is that they would make him go drive around, you know, some less desirable hotels, motels, I guess, and he'd have to run all the license plates in those less desirable motels. And if he got a hit, then he'd have to go to the, you know, motel manager and find out who's in there and go and knock on the door and see if he has to arrest them. You can imagine, you know, probably not the funnest thing to have to do. And so he would be upset. So patrols would be an activity that's formed by the police department, right? Okay, now character is to tell us what is the period of benefit of the expenditure. Okay, and you can flashcard some of this. Current expenditure, what do you think? Current period. Capital outlay, okay, probably you know, benefits the future, I mean the current period, but also probably the future periods as well. Debt service, you know, borrowing money to operate the way the federal government does is not very common. Okay, and the federal government can get away with it because it issues securities at a risk-free rate of return, unless they default in a couple of months. Okay, but they're supposed to have a risk-free component to it so they can borrow to operate. Most entities cannot. And so if you're borrowing money and you're paying principal and interest on debt, that's called debt service. And the notion is that you're matching those payments with whatever the benefit is. So you borrowed money for some sort of long-term purpose. So it can benefit the current period, but again, notice for both debt service and capital outlay, there's a future period component to that. Okay. Object class, think of that as a chart of accounts. Okay. So what happens? You could say that I have, you know, expenditures for salaries. I have expenditures for, you know, properties, whatever it is. Okay. And you can give all these different chart of account type of things. Okay. And there's no set amount that they have to use. The government can choose. And if you were to pick up an annual report of a state or local government, whatever, you would see that there are varieties as to how they display their expenditures on their statement of revenues, expenditures, and change in fund balance. Okay. As you know already, fixed assets, when we purchase them, they are what? They are considered an expenditure. Okay, they're considered a capital outlay. So if you buy police cars, okay, you would debit expenditure. You credit something and it's not accounts payable, it's called vouchers payable. Okay, and a voucher is something that will have several expenditures on it. And a voucher is a way of controlling the expenditures. I would sign off on those, and then someone would know, okay, these are all legitimate amounts that need to be paid. And later on, when they went to pay that voucher, they would look for the approval for all those different expenditures that are constituted on that particular voucher. That's all that means. So you don't use accounts payable, use vouchers payable. Of course, if you're paying the cash up front, you would go ahead and credit cash. Okay. Now, if we're treating as on our governmental funds under modified accrual basis, purchase of equipment as expenditure, okay, for fixed asset acquisition, don't forget that the fixed assets under full accrual accounting will be reported at the government-wide level. So we're literally would have to bring on things that we treated as expenditure at the governmental fund level. We'd have to bring them on as equipment at the government-wide level when we converted our government modified accrual financial statements to full accrual statements at the government-wide level. Don't worry about that yet, but we will have a brief discussion on that when we get to that chapter 10 material. 4 or 5 points that deal with that process. Not a real heavy area for us, but we will spend some time talking about that next time. Our proprietary funds and our and our fiduciary funds, okay, the remaining of our 11, the remaining 6 funds, 2 proprietary, 4 fiduciary, they use full accrual accounting, so they would be recording fixed assets, etc. Okay, good. Debt, long-term debt. Okay, long-term debt. We don't have long-term items on our, remember, we're talking about the governmental funds here. And so what happens is we would treat them as an other financing source. Okay, we treat them as an other financing source. And so when we issue debt, government issues debt, say for $1 million, a bond payable or something, we're not going to credit bond payable, not at the fund level, because there are no long-term liabilities. We debit cash, we credit other financing sources. Now you come down and you look at that pass key down there, okay, and let's just take a look. And they tell us that for our governmental funds, under modified accrual, we record the proceeds from long-term debt as an other financing source, and it's shown on the statement of revenues, expenditures, and changes in fund balance, not the balance sheet. In other words, we show it where? On the income statement, and you can put C page, and I want you to put C page F920. And when you come over to page F920, you gotta get out of this to go to F9. And when you go to page 20, F920, we were on F919. Now we're looking at the thing that is like the income statement for a governmental fund, okay, in this case, the general fund. All the governmental funds that says like IS. All the governmental funds, okay, prepare the same 2 financial statements, a balance sheet and a statement of revenues, expenditures, and change in fund balance. The balance sheet is the balance sheet. The statement of revenues, expenditures, and change in fund balance is like the income statement. And so you start to look, and we have our revenues, property taxes, right? Expenditures, hey, they're using a character outlay there, a current. Then they start breaking them into the different government programs. So they're using a program function approach. Then they go back to a character, telling you whether it's capital outlay, etc., right? Now, after we get to this, they give us this number, excess or deficiency of revenue over expenditures. This is like non-operating. This is like, damn it, John. Oh, come on. This is like operating. Income. But we don't call it that. We call it excess of revenue over expenditures, whatever. And then we start getting into things that, remember, I said our other financing sources and uses are like non-operating items. We talked about that last time in the organization of the statement of revenues, expenditures, and change in fund balance. And you have transfers in, transfers out. We'll get to that later. But also you would have what? Long-term debt proceeds showing here. And in that example that they just showed us, I guess that was $1 million. I'm just writing that in to tie it to that example that we were just looking at. So it is what? Think about it, guys. It's debt. You're getting money. You have to pay it back. But because we don't have long-term items for our governmental funds, you treat it like a revenue. I mean, it shows up as a other financing source there. It's like a revenue. Okay, modified accrual accounting. All right, good. Now you come over and go back to the page where we were. By the way, I think this is a good time for me to say this because I keep flipping back and forth to the statements. As far as I know, Becker is the only place where you get a full set of government financial statements that are effective for teaching. They have this Progressive Township. It's not a real organization. Okay, Becker has an individual by the name of Tom Cox. And Tom is a maniac. I mean, he puts this stuff together so that it all ties together into a full set of teachable financial statements. I've looked at a lot of governmental textbooks over my years, and every time what they do is they just flip in some states or cities financial statements and say here, and they just show it to you, and they don't do a good job tying it back to the concepts that we're learning and whatnot. I mean, I guess maybe Tom could have shown $1 million or whatever it was. Borrowing is another financing source there, but the man's only has so much time. He's put together a full set of financials that are effective for teaching, and that's the reason that I kind of like to toggle back and forth, so I'll do that from time to time. Okay, with all that, and Tom isn't paying me to say all that, I truly believe that. Okay, let's go ahead and don't worry about these leases. Let's just go over and let's take a look at, okay, Tom does a little bit of overkill here on some of this stuff. And let's just take a look at some multiple choice questions. This is our first question of the night, right? A little late in the evening for that, but better late than never. Okay, looks like everybody's had a chance to try this one, so I'm gonna go ahead and end a little sooner than the 2 minutes. And I would think a question like this, when you're on the exam and everybody got this right, would probably take you maybe 30 seconds, maybe 45 seconds to answer. Okay, so the other good thing about governmental, they give you a lot of questions, but if you get good at them, you start to get a time savings that you can apply to me what are more difficult areas. Okay, but everybody got this right. But let's just review the journal entry for recording the beginning of the year budgetary entry, and they tell us that they have estimated revenue here, and the estimated revenue is 100,000. So I'm going to debit estimated revenue 100,000. They tell me that they have appropriations of what? 80. And so I'm going to credit the appropriation. I'm just going to abbreviate that, approbe, for 80,000. And then I have to credit something. And the answer is I credit what? The name of the account is budgetary control for 20. Okay. And so they asked me, well, what is the part that goes to appropriations? Remember, guys, I keep reminding you, when you get asked a question and they give you all this information, and then they sit there and, they give you a half of a journal entry, don't fall into that trap. Make the full journal entry and then quickly compare it to the choices. That's the quick, safe way to answer the question. And so we have to do what? We have to credit appropriations, which everybody got. Okay. Now, this second question, I'm not going to put up as a poll, because now they're asking me what? Well, what should I do with the 20,000 excess? And we've already seen that we should do what? Credit budgetary control. Question? Okay, good. Let's take a look at this one. Okay, we're up on the 2 minutes now, and it looks like everybody's had a chance to try this one. And this one's maybe a little tougher here at the beginning, but looks like most of us got it correct. Okay, but let's just go ahead and let's see how we got to the right answer. And I want to play with this one a little bit too. So they tell us that this Oak City for year one, they tell us these different collection times, and then they want to say for year one, what should we report as property tax revenue in the fund financial statements? If they're saying the fund financial statements, what type of accounting should we use?
Modified.
Modified accrual, because that's what we use at the fund level when we're dealing with property taxes, right? That's going to go into the governmental funds. Good, we'll use modified accrual. Okay, excellent. So are amounts that are collected in year one, will they be revenue for year one?
Yes.
Pertains to property taxes for year one, and it was collected in year one. So yeah, gotta pick that up. How about amounts that are expected to be collected in the first 60 days?
Yes.
Yes.
Okay, now we sit there and say, well, okay, they haven't told us that they have a 60-day criteria, but there is no 500. Oh, there is a 500,000 answer. Okay, so this question's got a little bit of a clunkiness to it. They should have told us that they apply a 60-day criteria, but okay, you know, I guess we're going to have to roll with some of this clunkiness here. How about expected collections during the balance of year two? Well, now they're getting out into what amounts that may be well even out beyond 180 days. So we're not going to pick that up. Okay. During year three, now they're really getting out there. And if it's uncollectible, we're never going to get it, right? Okay. So the answer here is what, 600,000? I think somebody picked 500,000, and I see why, because they weren't real clear that they're applying the 60 days here, and it's not something that's in statute. The GASB doesn't say 60 days. It's common though that it is 60 days. So if you see 60 days being used like that, just go with it on the exam, right? Okay. Now that's in the fund financial statements, modified accrual. What if they asked me government wide? Doesn't matter when I collect it. Under government wide, do we apply the 60 days under full accrual?
No.
No.
No, as long as we're going to collect it, we'll take it as a revenue. Are you going to collect 10,000? No, they tell me it's uncollectible. So that means what? I take the 700,000 minus the 10 that's uncollectible for full accrual at the government wide level. It would be what? 690. Now let's just kind of compare the journal entries a little bit here. Okay. For government wide, debit taxes receivable. Okay. Debit tax receivable for the full 700,000. Credit revenue, as we've seen, for what? 690. And credit what? The allowance for uncollectible taxes for 10, right? Okay. If we're talking about, say, the general fund, I'm just making that up. They didn't tell us the general fund, but it probably would be the general fund. We still debit taxes receivable for the full 7. We credit revenue, as we've seen now, for what? For 600,000. We will credit deferred inflow. And the credit to deferred inflow is going to be for what? These amounts that they're thinking they're going to collect outside of the 60 days, which is what? The 30,000, I guess. No, I mean, yeah, 30 and the 60, so that's 90,000.
Yeah.
And then they also would credit the allowance, just like we did the government wide level for the 10,000 for the amounts that aren't going to be collected. Now, let me ask you a question. How about this 90,000? what year's revenue will that be? Year one, year two, or year three? Well, we see it's not year one. Will be year two, or year three revenue?
Year 2.
Good, the 90,000 is gonna be year two, because what? Well, 60 of it's gonna be collected in year two, and 30, even though it'll go into year three, will be soon enough to be counted in what? Year two's revenue? Okay. Okay, good. Come over. And I think you can see, guys, that even though I'm turning this into, this comprehensive question, I think you can see that just remembering the 60 days and you don't remember was enough to be able to answer this question. You'll get a lot of questions like that. And I'm just being a little more complete in the discussion. Okay, okay, good. Let's take a look at this question. Okay, looks like, yeah, I think everybody's had a chance at this one. So we're at 1 minute, 20 seconds. So I'm going to end the poll a little early here since we seem to have gotten this one, and share the results. And we're doing pretty good. We got, most of us got it right, but there's a little trouble with some folks want to pick C, but the answer is D. But let's just look at this one. And this problem, you kind of have to be completely cool with it. You have to kind of look at the choices a little bit and play. And that we're sitting here and they give us these different amounts of payment, and they want to know what amount should be treated as expenditure. Huh? Oh, shit. Okay, I see why some folks picked C, because I missed something there that I should have shown you. Okay, we'll come back. Let's see, how do I want to do this? I'll teach you here and then I'll show it to you where it's in the book. Okay, when you pay interest and principal on long-term debt, they are both treated as expenditures. And I apologize, I didn't show you that because I just missed it. Missed that I wanted to cover that with you in the book. Okay, but let's take a look. Purchase of a computer, yeah, okay, that's 300,000. You purchased a computer, you debit expenditure, not equipment, for 300,000, right? Okay, now you look at this 100,000 for the payment of principal on long-term debt. Remember that when the money came in, it was treated as another financing source. And when you pay back the money, it's an expenditure. There is no long-term debt for you to debit when you pay off that debt. So you have to treat it as expenditure. So when the money came in, it's run through the other financing sources section of the statement of revenues, expenditure, and change in fund balance. And when you pay the money back, you have to debit expenditure. And I'll show you that officially in the book here in a minute. So we know now from that discussion that both of those amounts are treated as expenditure. Now, when I look at the choices, there is no what? There is no 400,000. So I have to keep looking at this. And now the only way I get to another choice that could be the answer, I have to bring in what? The payments to the vendors. So apparently they bought some stuff from vendors this period. They debited expenditure and they credited cash. You know, if these were amounts that I was paying from another year, then it would be what? It'd be a debit to vouchers payable and credit cash. But the way this problem worked out, once I've picked up the 100 and the 300,000, I can't get to any of the other answers without making the now necessary assumption, which is that they debited expenditure and credited cash for whatever they bought from vendors this year for that 500,000. Question? Okay, good. Now you come over and you take a look at this next one. Okay, it looks like most of us had a chance on this one, so I'm going to go ahead and end the poll. And looks like a good chunk of us got this right. Okay, the answer is D. But let's just take a look here. And you look at this question and it says it would be inappropriate. Okay, and I have to kind of laugh because my friend has a 9-year-old son, and you know, poor kids get to an age where they want to have a sense of humor, you know, they want to be joking, but then, you know, he will start sharing like songs he's learned at school that probably shouldn't be sung at the dinner table. And so I'll tell him, hey, that's inappropriate. You know, you don't sing those kind of songs here with, you know, your mom here and, you know, other people here. That's inappropriate. So then we go to a restaurant and I guess they had some, you know, some of these paintings, you know, where everybody wasn't wearing all their clothes in the bathroom, you know, paintings up, you know, legitimate art. What's the guy's name? They drew all the weird Picasso type pictures, you know. And so the kid comes to the table. He says, when you go in the bathroom, there's non-appropriate pictures in there. So anyway, but you take a look and I see the word inappropriate and I think of that. But anyway, they say it'd be inappropriate to record depreciation. Well, let me ask you a question. If you record fixed assets, do you think you're going to record like you know, equipment? Do you think you're going to record depreciation? If you record fixed assets, are you going to record depreciation under accrual accounting?
Yeah.
Yes.
Yeah, I mean, that's one of the first things you learned, right? Okay, good. So it would be inappropriate to record depreciation in an account where I don't have fixed assets, I guess, then, right? And which accounts don't record fixed assets?
Governmental.
The governmental funds, which I remember through mnemonic GRAS, general fund, special revenue fund, debt service fund, capital project fund under modified accrual. I don't report fixed assets. I'm not going to have depreciation. Enterprise fund uses accrual accounting, so I'm going to have depreciation. Internal service fund uses accrual accounting. I'm going to have depreciation. Private purpose trust fund, although they may not have equipment, but if they did, then I would record fixed asset and record depreciation. And we'll talk about private purpose trust fund. Looks starting to look like that's going to happen next time. Okay, but let's come over, back, I should say, because I want to show you where in the book they talked about the payment. And the reason I missed it, now I realize, because I want to get down to that pass key and then I forgot to go back up. Okay, that when you make payments of both principal and interest, both principal and interest in the debt service fund are treated as expenditure. Okay, they would both show up on the statement of revenues, expenditures, and change in fund balance as an expenditure. And that's why I think a couple of us missed it, because I missed it. I forgot to show you that it was there. Okay, good. Let's come over then. And let's get ourselves to the next. Oh, that's it? Okay, that's the end of chapter 8. Okay, so let's come over then, because I think we have time to make some good progress anyway, into chapter 9. Okay, so I'm going to come into full screen. Yeah, I think we can get through at least module 1 here, chapter 9. Okay. All right. So again, guys, I'm not breaking out the governmental by category. I'm telling you, now I'm going to just go ahead and keep repeating it like a broken record, because I want to make sure 20 to 25 points in this governmental stuff. Okay. So don't sleep on it. Okay. So what we want to do, and just to look ahead, what we're going to do is deal up with some other transactions. And then probably next time, we'll just keep fighting until we get through this stuff. But we'll start talking about the different categories of the fund financial statements. And we'll roll pretty quickly through that. And then we'll have time for chapter on the first part of chapter 8 on not-for-profit, how we're going to handle government-wide. I'm going to have to think through, because I think that might start to fall down for us. But I think of the 30 government, 25 governmental points, 30 not-for-profit and governmental, that probably constitutes more like 5 points of that total of 30. So we'll have the big chunks by next time, and I'll think about how to handle government-wide. I may have some pre-recorded stuff I can have you look at, okay, that I've recorded. But let's just take a look at encumbrances. Okay, now what happens? Remember, we said that a government has to have the legal authority to spend money in its appropriation. We said that. If they spend more money than has been legally appropriated, they have committed a violation of the law. It is not a criminal violation. It is a civil violation. In other words, the government officials could be civilly liable for a fine, okay, if they exceed their appropriation. Okay, so what governments do to avoid all this calamity is they use encumbrance accounting. And what they do, even if they haven't received things that they have ordered yet, they encumber against their appropriation to avoid overspending. Okay, so let's just take a look. And again, guys, this is for our governmental funds that we're talking about. Okay, that we'll use this encumbrance accounting. We've talked about the transactions for modified accrual, but let's look at the encumbrance now. Okay, and so open purchase orders represent an encumbrance or a commitment of the available appropriation of a government in order for government managers to effectively monitor the degree to which they have used their appropriations. Okay, so as a result, not only the expenditure, but also the obligation to order will result, obligation to spend in forms of purchase orders will result in a journal entry. Okay, so let's just look at this encumbrance stuff. And guys, if you haven't had exposure to this before, there's no reason you shouldn't be sitting there saying, well, I don't understand this, or I've never seen this because I didn't study well. You've never seen this if you haven't taken a governmental class. Okay, so what happens when we order goods? Okay, we will have to debit encumbrance and credit an account budgetary control. Now, in this example, this government had an appropriation of 100,000. They don't want to overspend that. So they went ahead, and when they ordered 2 sanitation trucks, which are garbage trucks at 45,000 each, they debit encumbrance, they credit budgetary control for the total of 90,000. So anytime a government orders goods, you will do this: debit encumbrance, credit budgetary control. Okay. Now, what happens? They tell us that the first truck came in and the actual cost was 44,000, not the 45 that they had encumbered for. Notice, guys, flashcard, that when the item you have ordered comes in, you reverse the original budgetary entry for the original amount. Since I set this truck up for 45, I'm going to reverse it by debiting budgetary control and credit the encumbrance for 45. Then I can set up the actual expenditure by debiting the expenditure for the actual amount and credit cash or vouchers payable. I guess vouchers payable if I'm going to pay that later. Okay. Now, when you look at this appropriations ledger down here, and I'm going to come back up to some of that other stuff. Let's see why we're bothering ourselves with all this. So you have this appropriations ledger where we credited the appropriation. We saw that at the beginning of class tonight. We credit appropriation. We get our appropriation. That sits there as a credit balance in the appropriations ledger. Then we just saw that we debited encumbrance. And when we did, the appropriations ledger is useful to us because it says, hey, you got 10,000 left to go on this appropriation. Okay. If somebody runs in and says, hey, I found a new garbage truck that it kills flies on contact, we need to get this thing, it's only 15,000. Sorry, we don't have the appropriation on it. So we wouldn't be able to purchase that and say, go find us some cheaper if you want to buy some. Okay. Now what happens? Then when the item comes in, we credit the encumbrance, we debit the budgetary control. Now, when you credit that for a half a second anyway, right, this balance comes up to 55,000, doesn't it? When you credit it back. But in the next moment, I do what? I credit the expenditure. So now the expenditure has taken place of that use of that budgetary resource from the encumbrance, and I put that in at the actual amount, 44,000. Now I know I've got what? 11,000 left to go. So if someone runs in and says, well, I found one for 10,050, can we get that? Yeah, okay, now we can, because we know what the actual expenditure is on that first truck. Now we're still sitting there waiting for the second truck, right, to see what it's going to come in at. Okay, now what happens? You come over and we use encumbrances for ordering goods and some services, okay? But, and I want you to, I think what I want to do, flashcard is that second part of that discussion there. Encumbrances are not used for recurring expenditures such as salaries or debt service is another good example. Okay, and in flashcard that, and the reason they're telling us that is what? If a government issues debt, they have a schedule knowing when the principal and interest is due, And the legislature will appropriate enough to cover whatever that debt service is. It's not like we accidentally issue debt and oops, all of a sudden we have to start paying principal and interest on that. So they know what debt is or is going to be outstanding, and they appropriate what they need to cover that. Salaries. You don't accidentally hire people. You know how many people you have, and you appropriate enough to meet your payroll. And so it's not necessary to do encumbrance. With, things like equipment, like these sanitation trucks, okay, you got this money and you're spending it and you're buying stuff as you need it and stuff. You probably you should use the encumbrance for that. Okay. Okay, good. Now you come over and encumbrance outstanding at the end of the year, because what happens? I still have that second fire truck that has, or was it a garbage truck that hasn't come in yet, right? So what happens? If encumbrance is still outstanding at year end, then I have to reverse the journal entry and include outstanding encumbrances in the appropriate fund balance classification. And again, we haven't yet talked about the different classifications, but it would be either committed or assigned, and we're going to get to that eventually, the different categories of fund balance. Flashcard that, okay, and then let's go ahead and let's just take a look at the journal entry. And so at the end of the year, we have that fire truck that hasn't come in yet. Flashcard that you will debit encumbrance and credit budgetary control as though that truck came in. That's the same entry that you made when the first fire truck came in. So you make that entry even though it hasn't shown up yet, but you can't debit expenditure yet because it hasn't arrived yet. So what you'll do is you will debit your unassigned fund balance and credit fund balance committed. And you might say it's committed for sanitation or whatever. Flashcard that. And what I want you to do for this one is look in this chapter F9, page 9, because now we're in F9, so we don't have to flip to a different chapter, but we do want to look at, why does that not seem right? Oh, not page 9. I think it was page, sorry guys, F9, where did I write that now? F9, page 19. Come on, computer, do your job. F9, page what? Page 19. Okay, so let's just go ahead and take a look at page 19 over here. Okay, is that page 19? Yeah, okay, and so let's just come over and look and remember we looked at this earlier and we had the inventory of 55,000, right? And the non-spendable fund balance of 55,000. See the committed to, and it's committed to sanitation 45,000. That was that 45,000 where we debited the unassigned to take it out of unassigned, and we credited the sanitation. So when you get to fund balance, remember that fund balance is like retained earnings, and you can have unappropriated retained earnings and you have appropriated. And when you want to appropriate retained earning, you credit the appropriated, you debit the unappropriated. Well, same sort of deal here, debit the unassigned, credit the committed in this case, and it shows us that it's 45,000, and it says that it is for sanitation. Now, at this point, when I made that entry, and I should have stayed in full screen. At this point, when I made this journal entry, okay, I went ahead and I debited the unassigned and I credited the fund balance committed. And I know internally that that's for that outstanding encumbrance. But when I showed you the statement, it said nothing about encumbrance. It simply said what? It's an amount committed for sanitation. So notice up here, and I want you to flashcard, encumbrances are not specifically detailed on the face of the financial statements, but may be disclosed if material. So even though I told you, I showed you on page 19, whatever it was, that, you know, we had an amount committed for the sanitation program, nowhere did it say that was encumbrance. You could provide that information if you want to disclose it, but it's not on the face of the governmental fund balance sheet. Question? Okay, good. Now, when that truck finally comes in, okay, that second truck finally comes in, then we'll report that in the year that we actually received it. And so we'll go ahead and we'll debit expenditure, credit cash or vouchers payable, whatever. Okay, but we'll call out the budgetary year that that money came from, because that presumably had come from what the prior year's budget authority. So we're, even though we're showing you this expenditure, say in 2023, if that was coming out of 2022's budget authority, we'd say expenditure, 2022. It's literally that crude where you actually put the year, that basic, where you put the year that the budgetary authority came from. If the truck costs $46,000 and we use the current year's budget authority for that, then we would debit what? We would debit 1,000 expenditure 2024, 45,000 expenditure 2023, and of course we credit the cash of the vouchers payable for the 46. So if you're getting the money from different budget years, you have to show the budget year that that money had come from for whatever that expenditure is for. Okay. Okay, good. Come over then and let's take a look at a couple questions dealing with encumbrance. Okay, guys, looks like most of us have had a chance to work through this question. So I'm going to end the poll and let's take a look at the results. And yeah, okay, most of us got this right. Okay, in fact, everybody got it right. Okay, but let's go ahead and let's take a look at what happens when you issue a purchase order. And they say which internal service account, internal account, they mean budgetary account, should we credit? And when I get a question like this, guys, I make the full journal entry. I know that I have to debit what? Encumbrance. And I credit what? The correct answer to this question, budgetary control. And I think everybody got that. Good. I'm telling you guys, 3-4 questions just like that. They might have some numbers in them, but dealing with your understanding of encumbrance, because they figure they didn't get to that, we're going to be able to keep them from passing the FAR exam by giving them a bunch of governmental stuff. Okay. Okay, good. Let's go ahead and let's take a look at this next one. Okay, it looks like everyone's had a chance to answer this one, so I'm gonna end the poll here. And come on. Okay, and the poll. And okay, pretty good. Most of us got this right. We have a couple of folks wanting to choose B. So let's just take a look at this one. And look, you know, most of the governmental questions, I think you can work in, you know, less than 2 minutes, but some of them, you might have to give them the full time that they deserve. So don't think that that means you got to rush, you know, because I'm saying you can work them in like 45 seconds. Sometimes don't think you have to rush through every single one of them. And certainly while you're learning this stuff, I recommend that you go through meticulously when they're asking me about journal entries to make the journal entries associated with whatever they're describing to me. So they tell me that Elm City issued a purchase order with an estimated cost of $5,000. Well, if that's the place, I do what? If that's the case, I debit encumbrance, 5,000. I credit what? Bud control 5,000. Good. Okay. Then when the supplies were received, the company invoice indicated that it had an actual price of $49.50. Okay. Well, if that's the place, I do what? I debit Bud control for the full 5,000, the original amount. I credit the encumbrance, just like we have said now we're going to have on that flashcard for 5,000. And what do? I debit expenditure, $49.50. I credit cash or vouchers payable for $49.50. Now, when I look at the, you know, choices here, that's out. That's out. I don't think anybody recorded that, chose that. And then it says, what should I debit or credit to budgetary control? And I'm only left with debit, so I don't have to worry about credits at this point. And so the debit to budgetary control after the supplies are received is what? That 5,000. expenditure got debited for 4950, not encumbrance. Question. Okay, here's what we're gonna do. Next time, optional class starts at 5 o'clock. We're done with the quarter, I mean, with the trimester here, the term. I will ask our e-learning folks to leave this open through to the fall. Once the fall comes, we have to close it because I guess presumably we're gonna run, 377 again at that time. And so we'll need the same portal for the new class at that time, but it can stay open until that means September. So it'll still be here. The recordings and everything will be posted here. My recordings are also on YouTube, as you know. But next time, for folks that want to, we'll pick up here. We will finish chapter 9. We will go back to the not-for-profit stuff for chapter 8. We'll knock that out. And then in terms of the chapter 10 government-wide stuff, probably I'm going to give you a link to a recording where I've talked about that stuff in a previous quarter. And even though previous term, even though, it won't be us live where you can ask questions and stuff, it'll be me lecturing to another class like we do here. And of course, you know where I'm at if you have questions. Okay, any questions, guys?
Do you keep your recordings in YouTube for a longer period of time?
They're there until YouTube throws me out. They're just not organized in any kind of manner because I organize them through the learning management systems. So you have to sift through, 4 and 5 and 6 different schools to figure out where they are. But I think the way YouTube lists them, they list them in order of frequency, recency or whatever. And so those more recent ones would be the ones that were for this class. And sometimes it has like, a page that kind of shows or I've described what the class is. So it's not the most organized way to go through, but it is a way to go through to find them. Someday I should organize that, but someday I should also lose weight. So I don't know which one's going to happen first. Question? Okay, guys, if I don't see you next week, good luck going forward. If you choose to come next week, we'll see you next week, okay?
Thank you. Good night.
Right,
5
guys.
to 8, same time, same place.
Thank you.
I mean, yeah, 5 to 8, yeah.